Welcome to this lecture on macroeconomic trends and economic growth. In this session, we'll explore the key concepts, theories, and models that define economic growth and its measurement and implications. By the end of this lecture, you'll have a solid understanding of how economies grow and the factors that drive long-term economic development. These concepts are fundamental in understanding how economy evolves over time, why some nations prosper while others struggle, and what policymakers can do to influence growth. Let's dive in. Before we begin our discussion on growth, let's consider an interesting historical example. In the late 1980s, Colombia had national debt of around $10 billion. Pablo Escobar, the infamous drug lord, even offered to pay off his debt in exchange for immunity. This highlights how significant national debt can be and why managing debt is a crucial part of macroeconomic policy. But how does the debt relate to economic growth? Let's find out. Macroeconomic trends refer to long-term patterns in an economy that influence its performance. These trends help policymakers anticipate changes and implement appropriate strategies. Factors such as inflation, employment levels, interest rates, and government policies all contribute to shaping macroeconomic trends. Economic growth is a sustained increase in output of goods and services in the economy over time, typically measured by changes in gross domestic product. To get a clearer picture of growth, we focus on real GDP, which accounts for inflation. A rising GDP indicates an expanding economy, more job opportunities, and increased income levels. But why is economic growth important? Economic growth has a profound implication for a nation. It leads to more job opportunities, better wages, improved standards of living. With a growing economy, governments collect more tax revenues, allowing them to invest in infrastructure, education, and healthcare. Growth also fosters innovations and entrepreneurship, contributing to long-term prosperity. We have usually two major types of economic growth, extensive and intensive. Extensive growth happens when an economy expands by increasing inputs such as labor and capital. On the other hand, intensive growth is driven by improvements in productivity, technology, and efficiency. Let's break down further. Extensive growth relies on increasing resources such as larger labor force or more capital investments. However, this approach has limitations since resources are limited. In contrast, intensive growth depends on advancements in technology, better education, and innovative management, make it more sustainable in long run. Here you can see very interesting graph which represent the data about the world GDP over the last 2 millennia. And a lot of people think that the mankind is experiencing steady, consistent economic growth. As you can see, it's a wrong assumption. Why? Because the world's GDP is evolving in geometric progression, starting especially from the mid 18th century, which has driven by the Industrial Revolution. The first Industrial Revolution was based on the steam engine. The second one was caused by the invention of the internal combustion engine electricity. The third one was caused by the computers, and the fourth one was driven by the internet itself. So over the last 300 years we have done more than our ancestors previously over the last 2 million years. That's how the economy is evolving. Economic growth rate, or EGR, is typically calculated utilizing the following formula: real GDP in the current year minus real GDP in the previous year, and this volume is divided by the real GDP in the previous year and multiplied by 100 in order to receive the percentage value. This formula helps us quantify how fast an economy is growing year over year. Let's apply this formula to an example. Suppose the country X had a real GDP of $500 billion in 2022 and $530 billion in 2023. Using this formula, we can now calculate the EGR, or economic growth rate. 530 minus 500 divided by 500 multiplied by 100 gives us the value of 6%. This means the economy grew by 6% over this year. Try applying this formula to other real-world GDP figures. Here you can see the data of the real GDP, which is adjusted to inflation in billions of United States dollars for the specific country. Called Ireland, yep, over the last 5 years, starting from 2020 up to 2024. And here we have these volumes. Your task is to determine the EGR, economic growth rate, for every of these years. So applying the formula, we receive the data for 2021, because it's impossible to receive the data for 2020 because there is no data for the previous year. So that's why the first year we can determine the economic growth rate for is the 2021. As you can see, the economic growth rate was 3.33%. 2022 is 1.08. 2023 4.26%, and 2024 was marked by the economic growth rate of 5.10%. As you can see, the highest economic growth rate was observed in the 2024. Okay. The GDP growth rate may vary across the countries due to differences in resources, policies, and economic conditions. For example, Kazakhstan's economy grew by 5.1% in 2023 due to increased oil production and fiscal stimulus. However, some countries experienced negative growth due to recessions or crises. As you can see from this table, I really like this table because it provides the data for 2022, when the world was recovering from the COVID-19 pandemic. As you can see, the highest economic growth rate in 2022 was observed in the country called Maldives, 41.75%, because in 2022 they experienced a significant economic growth rate because in 2021 the real GDP was significantly lower, because of the shortage of the tourists, which were one of the major sources of incomes for this country. In 2022, the EGR for the Kazakhstan was 4.3, which puts Kazakhstan in the position of 108 within the world ranking, according to the Central Intelligence Agency of the United States of America. The worst and the lowest volume of the EGR was observed in Afghanistan because of the Taliban controlling the whole country these days. One of the reasons why it happened because the Taliban prohibited all the female workers to work. As a result, they just deprived the large part of the population from the jobs and the opportunities to contribute to the GDP. Okay, try to get these countries. The left one is Singapore, where the level of GDP per capita equals $127,000, and to the right we observe the image from the Democratic Republic of Congo, where the GDP per capita is $529. Interestingly, Democratic Republic of Congo possesses vast mineral resources, while Singapore has absolutely nothing. A common assumption is that when a country's GDP increases, the standard of living also improves. But is that always true? Not necessarily. When GDP measures the total economic output, it does not directly account for how wealth is distributed or whether people's daily lives actually improve. Key considerations are the following. If GDP growth but the population grows at the same rate, GDP per capita remains unchanged, meaning individuals may not see any real improvements in their well-being. If economic growth is concentrated in the hands of a few, when majority of the population might not benefit from the increase in GDP. If prices rise alongside GDP, people might not experience a higher standard of living despite the economy growing. Here we can see the graph of the indexes of the real GDP and the real GDP per capita in Canada starting from 1995 up to 2014. As you can see, this graph, the higher one, is just demonstrating the real GDP. But the real GDP per capita was also decreasing, but at significantly lower pace. The question is, why that? The answer is very simple. Despite the significant increase in the real GDP, the Canada was also experiencing the population growth, which resulted in the significantly low growth in GDP per capita. It was significantly less than the real GDP. One of the most crucial aspects of economic growth is understanding how small differences in growth rates can lead to large disparities in economic outcomes over time. Remember, even a slight variation in annual GDP growth can make a significant difference in a country's long-term economic trajectory. This is due to the power of something which is called compounding growth. Why do growth rates matter? A difference of just 0.5% or 1% in annual growth might seem minor in short term. However, when these differences accumulate over decades, the impact becomes massive. The countries that sustain high growth rates for long periods experiences rapid economic expansions, while those with slower growth stagnate or fall behind. To better visualize the impact, let's examine how different growth rates affect GDP over time. Suppose we start with the economy that has an initial GDP of 100%. This table demonstrates how a small change in growth rate leads to a huge difference in GDP after 40 years. A country growing at a pace of 4% annually will see its economy expand nearly fivefold, while a country growing at 0.5% will only see an increase in about 25% over the same period. Now let's talk about one of the fundamental concepts in macroeconomics, the production function. At its core, the production function describes how an economy transforms inputs like labor, capital, and technology into output, which we measure as gross domestic product or GDP. Mathematically, we express the production function something like this. Y represents the total output or GDP. A stands for the level of technology which influences how effectively inputs are utilized. K stands for the machinery infrastructure, or in other words capital. L represents labor, meaning the workforce that contributes to the production. This function tells us that output is determined not just by the quantity of capital and labor, but also how efficiently these inputs are combined, which is influenced by the technology A. Why is the production function important? Understanding this function helps us answer crucial questions in macroeconomics. How can an economy grow over time? What happens when we increase labor or capital? Why do some countries grow faster than others? Now, let's dive into an important concept in economics, the law of diminishing returns. This law explains why, after a certain point, increasing one input while keeping others constant leads to smaller and smaller increases in output. Imagine if a farmer works on a fixed piece of land. At first, if the farmer adds more workers, the total output of crops increases significantly. More hands mean more crops harvested. However, As more workers are added, they begin to get in each other's way, and the land becomes overcrowded. Eventually, adding more worker contributes less to output than the previous worker did. If too many workers are added, productivity might even decline. For instance, that's how it works. A factory with only few workers can increase production quickly when the new workers are added. But if too many workers are hired, they start competing for machines and workspace, reducing productivity. And here we have something which is called the negative marginal returns phase. Mathematically, the principle can be explained through the production function, where output depends on the capital and labor. Here we have the case of the capital, which is described as the square root of this capital volume. So adding additional unit of capital leads to a smaller and smaller increase in output. Now let's explore a fascinating phenomenon in economic growth theory called the catch-up effect. The catch-up effect refers to an idea that poorer countries tend to grow faster than richer countries, allowing them to narrow the income gap over time. This happens because low-income economies have more room for improvement, while advanced economies grow more slowly due to already high levels of productivity and capital. That's how it works. So the additional unit of labor capital in developed countries, which are already rich, results in a smaller increase in output per this unit, while the poor countries have a wider space for development. Let's now examine an insightful historical perspective on economic performance with this slide. The evolution of output per person in four rich countries since 1950. This slide presents a comparative analysis of how output per person, a key indicator of a country's standards of living, has evolved over time in four advanced economies: France, Japan, United Kingdom, and the United States. Notice that each country has its own average annual growth rate over the period from 1950 out to 2009. For example, Japan shows an impressive rate of 3.9%, reflecting a period of rapid catch-up and industrial transformation. In contrast, the United Kingdom and the United States exhibit more modest growth rate, around 2% and 1.9 respectively. These demonstrate that even among wealthy nations, growth dynamics can vary considerably. Also, this slide provides data on output per person at 2 points in time, 1950 and 2009, and then calculate the overall growth between these years. These not only reflect the changes in productivity but also highlights improvements in living standards. For example, Japan's output per person increased dramatically, underscoring how industrial policy, technological innovation, and capital accumulation can rapidly boost economic performance. Japan's rapid rise in output per person, which is a classical example of the catch-up effect, where a previously less developed economy can accelerate growth by adopting advanced technologies and management practice. Moderate growth in countries like the United Kingdom and the United States, where mature economies experience slower but steady improvements in productivity. So, why this matters? Understanding the evolution of output per person is essential because it directly relates to the quality of life. When output per person increases, it usually translates into better healthcare, education, and overall living conditions. It also provides the policymakers with insights into which sectors or reforms can further stimulate productivity. In summary, this slide encapsulates the long-term evolution of economic performance in terms of output per person, offering a clear window into how historical growth rates translates into real improvements. And definitely we can observe the obvious example of something which is called the catch-up effect, when Japan gained on developed countries over this 60-year period. As I already mentioned before, the South Korea case is the obvious example of something which is called the catch-up effect, where the average annual growth rate there, starting from 1960 up to 1990, was 6%, when the United States has been demonstrating the increase of 2% respectively, because the United States of America has already been a developed country. Now let's turn our attention to one of the most fundamental models in economic growth theory, the Solow growth model, which has been developed by the economist Robert Solow in the 1950s. This model provides a framework to understand how economies grow over time by focusing on three key factors: capital accumulation, labor growth, and technological progress. But first of but first of all, we have to take into account that the solo growth model usually presumes that the economy of the specific country is closed, so it does not interfere with no international trade or any capital flows. The economy produces only single homogeneous product or identical product. As also the economy is performing the constant returns to scale. Capital and labor are the major inputs within the production process. A fixed proportion of output is saved and invested, and labor grows at a constant rate because of the population growth, and no technological progress was emerged initially, which would be introduced later. So these are the major assumptions we have to take into account in order to understand how the Thorough growth model works in the real case. As you can see here, the production function in the Solow model follow this general form. The production is the function of overall level of technology within a specific country, which stands for A, which is also the function of K, which is a capital stock, and labor quantity, which is represented by the L. At the first glance, this looks similar to the basic production function we discussed earlier. However, the Solow model introduces capital accumulation and diminishing returns, which fundamentally shape how economies develop over time. In this slide, we'll explore an essential mathematical representation of economic production described by the Cobb-Douglas production function. This function plays a fundamental role in the Solow growth model and many other economic frameworks. It describes how an economy transforms inputs, capital, and labor into outputs, showing how these inputs interact and contribute to economic growth. That's how it looks like. So this letter stands for alpha, which describes the elasticity of output with respect to capital to labor. If alpha is 0.3, it means that 30% of the output depends on the capital, while the remaining 70 depends on the labor. If we increase both capital and labor by the same production, total output will increase by the same proportion. This means that if we double capital and labor, output would also double. Mathematically, the function exhibits constant returns to scale, meaning this equation. What does it mean? Increasing capital without increasing labor eventually leads to a slower growth in GDP. And technology, which is represented by the A letter, is a key driver of long-term growth. Unlike capital and labor, technology does not experience diminishing returns. Innovation, education, research help economies push beyond the limits of capital and labor. In this slide, we'll focus on one of the most important measures of economic performance: productivity, or output per worker. Productivity measures how much output, goods and services in other words, is produced by one worker in economy in the specific amount of time. It's usually expressed by this equation. So the output per the unit of labor. The ratio helps us understand how efficiently an economy is using its workforce to generate goods and services. The more each worker produces, the higher the total income in the economy. Higher productivity allows for higher wages, better working conditions, and improved quality of life. Workers in Switzerland and the United States are highly productive due to advanced technology and education, resulting in higher wages. Now, let's explore the relationship between output and investment, which is essential to understanding economic growth. Higher output usually leads to higher investment. This is our output and this is our investment, because the major source of investment is output, which helps you to generate your revenue. When the economy produces more goods and services, it generates more income, which allows the companies to save more. Higher saving means more funds are available for investment in capital goods like machines, factories, and infrastructure. This is something which undermines the cyclical nature of macroeconomics. When businesses invest in new capital, workers become more productive, leading to higher future output. Investment boosts business activity, leading to job creation and higher income. In this case, we have a margin propensity to save of 0.3. According to the macroeconomics assumptions of a closed economy, the major source of investments is the money you saved before. So all your savings should be invested in the future. But remember, economies cannot rely solely on capital accumulation. Technological progress and efficiency improvements are essential for sustained growth. In addition to investment, we need to consider another factor, depreciation, which represents the natural wearing out of capital over time. Machines, buildings, and equipment lose value and efficiency over time. Depreciation refers to the rate at which capital stock deteriorates and needs replacement. If investment is higher than depreciation, the economy's capital stock growth, leading to more output. If investment equals depreciation, economy reaches the steady state where capital stock remains constant. If investment is lower than the depreciation volume, the capital stock shrinks, reducing productivity and output. What do we see right here? We have the investment level, the investment in capital, labor, and etc. But also, the more we invest in the future, the higher the depreciation. It's a nature. So it's a physical feature of the metal, people, the buildings, and etc. And remember, depreciation is inevitable. Steady state is the point where an economy's capital stock, output per worker, and income per worker remains constant over time, unless influenced by technological progress. At this stage, new investment is just enough to cover capital depreciation and population growth, so capital per worker does not increase further. If investment exceeds depreciation, capital stock grows, as already told. If investment is less than depreciation, capital stock shrinks. The economy reaches a point where net investment is zero. This is the steady state. In other words, all of the investment is just being used just to repair and replace the existing capital stock. What are the major implications of the steady state? No long-term growth in output per worker without technological progress. Higher savings rates shift to the steady state to a higher level, meaning the country will have more capital and output per worker. And higher population growth lowers capital per worker, making it harder for countries with rapid population growth to accumulate wealth. Can an economy grow beyond the steady state? The answer is yes, but only through technological progress. If technology improves, an economy can break through the steady state ceiling and achieve sustained growth. For example, China's rapid growth in recent decades came from the capital accumulation and catching up to developed nations. However, as it approaches to its steady state, growth is slowing. The United States of America grows steadily because the continuous investment in technology and innovation rather just increasing in capital. What do we see right here? Despite the fact that the GDP is rising, the output is rising, the initial phase was marked by a significantly higher pace of growth. Why? Because initially the rate of the net investment was significantly higher because the depreciation was relatively low, because the units of capital were pretty new, so they were in a working condition for a consistent period of time. Here we have the situation, it's a steady state of economy. Here we have the situation in this phase when the depreciation is higher than the investments, so the country is paying high amount of money just to keep the existing resources in working conditions rather than creating the new capital resources. But the question arises, what if we try to save not 30%, the previous case, 30% of our income? What if we try to save more? So we increase our marginal propensity to save. In this case, this steady state would move to the right, and this situation will occur later, but it does not solve the problem in its core. The steady state will occur inevitably, but it will be later. We just push this scenario to the later times. So I already told you, anyway, there will be the new steady state position, but it will be later. So what does it mean? The increase in marginal propensity to save is just a temporary measure. Okay, so one of the key equations within the solo growth model is the change in capital stock over time, which is determined by savings, investments, and depreciation. This equation explains that capital stock increases with investment and decreases with depreciation. If investment is greater than depreciation, capital stock growth. If not, it shrinks. So this slide is demonstrating again how the solo growth model looks like in theory. Economic output, or presented by Y, saving, which is usually measured by the marginal propensity to save, as a result the investment. The net investment, which is zero, and the point where the saving intersect with net investments is forming the steady state of economy. So what is the major key implication of the solo growth model? Solo growth model provides the several key insights in how economies grow over time. Investment in capital raises output but faces diminishing returns. Long-term growth cannot be sustained only through the capital accumulation. Poor countries tend to grow faster than rich ones because they have lower capital stocks and higher marginal returns to investments. Remember the catch-up effect. And without innovation, economic growth stagnates. Remember, investing in education, research, and development leads to continuous improvements in productivity. So, technological progress, which is represented by the letter A, is essential for sustained long-term growth, according to the Robert Solow model. Okay, ladies and gentlemen, thank you for your attention. This is the end of the theoretical part of this lecture. If you have any kind of questions, don't hesitate to contact me. See you.